Well, first up, many parts of the South African equity market look very expensive. Investors that have money to invest would need to err on the side of caution and either restrict the amount of money they want to invest by sitting out of the markets for a period of time, or alternatively use derivatives to hedge themselves. Liang Du from Prescient Investment Management advocates the latter, and he joins us from Cape Town to share his views. Well, let's start right there, Liang, and why we should be exploring derivatives.
Absolutely, Bronwyn. I think what we usually see is that when you look at an equity cycle, what people usually do is after the fall, you maximize your equity. And as the market rises, you decrease equity. So you go toward neutral. And as the market gets quite expensive, you sell out of equities completely, sitting almost in bonds and cash. Now, in this cycle, two things stand out. The first thing is that interest rates are extremely low in this cycle. In spite of equities becoming quite expensive, bond yields as well as cash yields are almost at all-time lows. Absent last month's action, of course, a lot has changed in 1 month. So what we found, and we find when we do backtesting, is that if you get out of equities too early, so a perfect example would be in 2008, when equities, let's say, the recession in the US started at the end of 2006, almost September 2006. So were you out the market in 2006, the top 40 index was about 19,000. It went on to rise all the way to almost 35,000 before falling. So you would completely miss out the last part or the bubbly part of the market. An attractive alternative is to protect your equities. What that does for you is that it removes the downside completely, but you pay away a little bit on the upside. And what you tend to find is that towards the end of a bull market, protection becomes extremely cheap. So it almost makes perfect sense to do that.
Liang, we've obviously got this situation where the market is looking expensive. So I wanted to just get your take on how expensive the JSE looked overall, and then we can talk a little bit about obviously there's different pockets of value within the market. What you're doing from the perspective of the portfolio you're managing to buy this protection and what it's costing you. So maybe you can just give us your insight as to why or how expensive the market is at the moment.
Okay. If you're looking at our market on a pure PE basis, we're probably sitting at around a PE of 19 to 20. If you look at that in the context of history, it's certainly towards the top end of how expensive the band is. I think the only saving grace for us is perhaps that if you look at 5-year real earnings growth, we are looking at the lowest point in history since the 1980s. So our earnings, has been quite slow, and that cycle is not up. So when you're looking at peak earnings and peak valuations, you want to have no equities. But when you're looking at, let's say, quite peak valuations, but still quite low earnings, perhaps there's room to pause and really think about it a little bit more.
Then we've got this.
Right,
sorry, just to put this question to you, we've obviously seen some pockets of the market, like the industrials, have been, and the retailers to a lesser degree, have been very expensive for quite a while. So there's obviously an opportunity cost at this point. I mean, when we talk about buying protection or sitting out of the markets, as is the case with the portfolio we're talking about today, the Balanced Quant Plus fund, how easy is it to time the market? Because you could obviously miss this uprun continue for quite a while longer before it actually starts to correct.
Absolutely, Warren. I think that's exactly why we advocate protection rather than going out of equities when it's expensive. And when protection is cheap, of course. So if the price of protection has risen a lot actually over just the last month, so we're a bit more neutral. But when price of protection is very cheap, you would rather stay in so that you can capture should it continue to run rather than sitting out in the sidelines.
Liang, can we break that down into a specific stock? And I see in your verbiage here you speak about Sasol specifically. Can you tell us how you would go about playing Sasol in the current environment, specifically in your fund?
Hi, Barrett. I think the key to our process is that each stock by itself is very difficult to do. So you rely on the sense of diversification. So you construct a portfolio as a whole, firstly, to limit your risk by diversification. And the second thing you can do is protect the portfolio as a whole via using index options, which is a lot cheaper than buying protection on single stocks.
And the Rand, how does that factor into your investment philosophy at the moment?
I think fundamentally the Rand, the fundamentals of the Rand is quite weak at the moment. I think we're seeing two big things. Number one, if you look at our trade account, it's actually one of the worst periods in our history. And if you look at what the budget speech and the Minister of Finance have been saying, this is likely to continue for the next 2 years. That is completely unprecedented. The second is we have a fiscal deficit as well, so government needs to issue bonds going forward. The combination of the twin deficits and perhaps a bit of negative sentiment has driven the rand from very expensive levels when they were at 680 all the way down to perhaps towards the cheap end now at 10 rand. So looking at it from that perspective, we're no longer at the expensive side of the rand, and the rand has weakened a lot, but the fundamentals are not there for the rand to recover strongly at the moment.
So sorry, Warren, one more question on the rand. We had a couple of players, specifically Ford in studio recently, saying that we are going to see this weaker bias for the rand being sustainable for perhaps 12 months out. Would that be a view that you share?
I think it's very, very hard to express in a short time frame of what the rand's going to do. But I think on the more positive fundamental side, if you look at perhaps the Mining Consultative Forum that's been held last week Friday by our Deputy President, I think that was quite a positive step to see, right? One of the big problems in causing negative sentiment in the rand, above and beyond our fundamentals, is the labour strikes and the labour issue that we've been having in South Africa, which is stopping us from having commodities to export completely. And I think if you look at the forum and the agreement that they're going to go there, hopefully, things like Marikana is actually the brink of where we're going to go in terms of bad relations. And going forward, government, business, and the unions will work together a lot more to bring a stronger industry.
Leung, just to come back to that, obviously with this Balanced Quant Plus fund, do you take individual positions in stocks and then, if I'm understanding you correctly, protect those positions using index derivatives, like you said, index futures, I think? Is that the correct way of what you're trying to achieve with the portfolio?
Absolutely right, Warren. I think when we select the stocks, we make sure that tracking error is limited. So we take relative risks relative to the benchmark. So what we try to do is generate consistent alpha. And in these stocks, what we pick is value stocks, quality stocks, and stocks that are showing positive sentiment. So stocks that show all three of those will be most overweight relative to stocks that are expensive, shows negative sentiment, and has no quality.
And you've got an interesting mix of stocks here because we see here that it's not just South African stocks, you've also included Chinese equities in there, and that's obviously on the basis we've had you on the show, we're talking about the China fund. So quite an eclectic group of stocks to put in the portfolio because obviously you've got exposure to South Africa and China as the two biggest geographies.
Oh, that's absolutely right. I think the way we see it is that in places like Africa and China, so in our portfolio we have things like Africa and China, and that's an attempt to capture growth at a reasonable value. And that's certainly the case that you're seeing in both Africa as well as China, whereas China is trading probably at multi-decade low valuations. And Africa, although valuations have reverted, Africa had an incredible run. It's up about 90% in rand terms over the last 18 months. Even now, it still seems reasonable value compared to South African equities. So certainly with a wider universe and a wider opportunity set, it looks a more attractive investment destination than South Africa right at this moment.
So Leung, just in conclusion there, you are net positive on the Chinese story. I see we had house prices out earlier today alluding to the property environment, and although we are trying to see Chinese authorities artificially slowing down that economy, it doesn't seem to be having much traction. Would that be a fair assessment?
I think the Chinese authorities are putting in a lot of very positive steps to rebalance the economy. And I think what that's really good for is a sustainable growth going forward in the long term, rather than having a bubble economy in the short term and then a subsequent collapse. So I think to me that's very, very positive. As I mentioned, like in South Africa case, we could use option protection to kind of mitigate some of that risk. In China's case, their market's not yet sophisticated enough to do that. However, we're trading at a PE of 20 and China's trading at a PE of 12.
So that